Cash flow positive, what is it and why isn't it profitability? What's the difference between cash flow and profitability? Well, the short answer is that I can have positive cash flow even if I'm running at a loss, and I'll be able to stay in business for as long as I can keep that cash flow positive. On the other side of it, I can be running at a profit and have negative cash flow, and I'll still be out of business even though I'm profitable on paper because I don't have the money that I need to pay my bills to continue as a going concern, which is what it's called actually in the world of auditing. So, important to understand, and this underscores everything I've been talking about in all of my prior posts where we looked at the balance sheet, we looked at the statement of cash flows, and we looked at the profit and loss statement, and this really brings it all home in terms of why it's important to look at all three financial statements. If I just look at one, I'm only seeing part of the picture, and you're going to see an example right now on my screen of where a company can be profitable. It can look like it's profitable on paper and still have negative cash flow, which is how we can end up going out of business even though we're profitable. Cash is king, and this is exactly why. Now, in the write-up, I gave you the example of purchasing a rental property that we're going to then rent out. And I said, let's assume the purchase price is $1.5 million and we're putting down 20% or $300,000, leaving us with a loan amount of $1.2 million to be paid off in 30 years at a rate of 5%. Okay? Now that translates to a payment of roughly $6,441 with 86 cents. This is our true cash flow. The expense, though, in month one is only $5,000. And of course, the balance between interest and principal shifts over time so that by the end of the loan, we're paying off almost all principal and very little interest, right? So in the earlier months, most of the payment is interest expense, but still interest expense isn't the total cash outflow. The total cash outflow includes the portion of principal which is reducing the loan and not showing up on our profit and loss at all. And this starts to underscore how I can have, expenses of $5,000 but cash outflow of $6,400. And so that's where you're going to start to see how this comes in, and we can look profitable and still go out of business because we have negative cash flow. So this is important to consider when we're looking at a business like this. Now, as I also mentioned in the write-up, one way we can solve this problem if this high monthly payment makes it very difficult to be cash flow positive is we can put more of a down payment down on the property. So if I double the down payment to $600,000, now look, my total payment comes down by almost $2,000 a month. So that makes a huge difference, and that can make the difference between being able to stick around and stay in business and not. So going back to the 20% scenario, let's record some transactions in QuickBooks and see exactly what this looks like. And by the way, before I do move on, if you want a copy of this, it is linked in the write-up. Just yours is going to be view only. Click on File and click Make a Copy, and that'll put a copy of this in your own Google Drive folder. This is done in Google Sheets. Okay, now let's start recording some transactions. I started the company off with $500,000 in the bank. And now what we want to do is let's write a check to cover escrow. Okay, so the payee would be some title company, and let's say the check is being written on, let's say, January 15th. And this is going to go into escrow clearing, and we're also going to add $10,000 to it because we're going to cover the settlement charges out of pocket. So $310,000 goes into escrow clearing on January 15th. Okay, then on January 31st, we're going to settle the property. So we're going to create a journal entry, and this is going to be very much oversimplified. But the purchase price was $1.5 million. We're going to come up with $310,000 out of escrow clearing, and we're borrowing $1,200,000. And the reason it's $310,000 and not $300,000 is we're assuming $10,000 in settlement charges. Settlement charges could be the commissions, the loan fees, the title fees, all of that good stuff. The purchase price goes to a fixed asset account. That's the value of the property we bought. This, again, I'm going to simplify it and call it all settlement charges. This is what we paid into escrow clearing. Now it comes out. And this, of course, becomes the loan payable. So this is a very simplified journal entry, but not totally far off the mark. The difference really would be that this settlement charges line item would be broken up into a bunch of lines to describe the different kinds of charges and fees that we're paying. And we're going to say that this happened on January 31st. Okay, and then let's look at an updated copy of the balance sheet. I've run this for all dates, and our escrow clearing did in fact zero out as I promised, $1.5 million on the fixed asset. We now have a loan of $1.2 million. And notice the net income closing is $10,000, and that's because if I update my profit and loss, I've got those settlement charges in here at $10,000 and no income yet. Right, so here we're already operating at a loss. Forget about having a profit and being cash flow negative, right? And if I look at my cash flows, then I have net cash, or the net cash increase for the period is actually $190,000, and that's because we put $500,000 into the business during the period, right? And we paid out the $310,000, right? And so the 500 minus the 310 is really how you get to the 190. In between that, we had the $1.5 million offset by the $1.2 million, right? So that's how we get to the 190. Now let's start seeing what happens now that we own the property, right? We're going to get some rents, we're going to pay a utilities bill, and we're going to pay the mortgage payment, right? So let's change the dates of these reports to this month, because that's what we want to analyze now. We want the month to stand on its own, because then this way you're going to see a nice clear illustration of what I'm talking about. So notice for this month, there's really no activity to speak of yet. Okay, we'll go back here and let's go get our rents taken care of. So on February 1st, we're going to get rents from our tenants. And again, I'm keeping things simple for the purposes of illustration. Let's say we have two tenants paying $3,500 a month each. And we'll say save and close. And then we're going to get paid those rents. We're going to assume they got paid right away on the 1st. Good tenants, pay on time. Right, deposit it straight into the checking. $7,000 in the bank. So let's see what's happened here. First on our balance sheet, we've now increased our checking account to the 197 because of the rent we collected. Nothing else really has changed here. Net income has changed because remember it was a loss of $10,000, but now we've made back 3, or 7 rather, for a net of 3 in the bank. Right, so there's our income for $7,000. No expenses. Right now we look nice and profitable. Update this report, and sure enough, we have our net income. Our cash flow for February is purely the income that we collected. Right, we charged $7,000 in rents, collected it, and put it in the bank. So real simple, real clear, real straightforward. Now, let's do the utilities bill. Let's go write a check to LADWP, the Department of Water and Power. We're going to say that happened on February 15th. Utilities, $1,000. Save and close. And then let's pay the mortgage. Let's say the mortgage payment we paid on February 28th, the first mortgage. That would be to the bank, whoever that might be. I'm going to leave it blank for this purpose. And remember, the mortgage payment is split up into 2 between interest and principal. The interest, we said, if we go back here, in month 1 is $5,000. The principal is the difference, or $1,441.86. Save and close. Let's update the balance sheet now. So we took some money out of the bank, right? We took a little over $6,000 out of the bank. The fixed asset doesn't change, but notice the loan payable goes down by the $1,441.86, and you'll see the net income closing number figure being reduced, right? Now let's go update the profit and loss. Let's run this report. So now in this scenario, we look like we made $1,000, right? So it looks like we're doing okay, right? We made a profit of $1,000. We got our rents, we paid the utilities, right? And we paid our interest. Notice the interest is only $5,000, but remember the full cash flow on the loan is more than $5,000. So let's look at the statement of cash flows and see, this is what I like to call the reality check. Here's the reality check. Yeah, we netted $1,000, but we paid out $1,441.86 to reduce the loan. That's not reflected in the net income. So our net cash flow is negative $441.86. So we're profitable by $1,000, but we're cash flow negative. How long will we be able to last at that rate? And that assumes there's no other expenses. We'll take the $190 or $189,000 we have in the bank and divide it by 441.86. That's how many months you could last, assuming everything is exactly the same every month, which we know it isn't. We know there's going to be more expenses. And the most we can do income-wise is rent out those other 2 units, right? So the point being, we can show a profit and loss that says, hey, yeah, we're making $1,000 a month free and clear. Makes things look really good. Even on the balance sheet, doesn't look too bad, right? You can't necessarily tell by looking at the balance sheet what's going on here. It's only when you look at the statement of cash flows that you get the real picture and say, yeah, we're making $1,000 a month, but because of the debt we have that we're having to pay off each month, we're still cash flow negative. And that's going to actually get worse and worse because the income will get more profitable because the interest expense is going to be less, but that difference effectively is going to shift over to make this even higher. So we're going to look more profitable while we actually have the same negative cash flow going on. So, my friends, this is really what I think hopefully illustrates and underscores how you can actually be profitable and still go out of business because you're paying off debt at a rate that's faster than you can keep up with based on the profits that you're making. As always, my friends, I hope you had some fun here and learned something along the way. Don't forget you can get a copy of that effective interest table. Just click File, make a copy after you've clicked the link in the write-up in order to access that. And as always, if you have any questions, comments, concerns, or feedback, post your comments below wherever you happen to be watching this. If it's right on YouTube, post it in there. If it's on fundira.com/blog, then just post your comments on this post right there, and I'll get notified and I'll get back to you as soon as I can with answers or responses to your feedback. As always, I hope you're having an absolutely fantastic day, and I look forward to seeing you on the web.